Hello everybody, Ninness here, your loan pro from Denver, Colorado with another installment of How Much Mortgage Can I Afford? Unfortunately, over the last few weeks, our camera was out of action, so haven't been able to do any new installments, but very much happy to be back with a new episode. Today we're going to be diving into paying points. As the interest rate market is changing, rates are increasing. How rates are advertised or even presented to borrowers and clients is also changing. So we're dedicating that episode to what you as a consumer can look at to be a good steward of whether or not you're getting a good deal. As always, we are in the game of helping people with their home financing right here in Denver. If you need any assistance, let us know. Otherwise, thanks for joining us on another episode of How Much Mortgage Can I Afford? Thanks again for joining me for another episode of How Much Mortgage Can I Afford? Interest rates are rising, and that is putting additional pressure on the housing market. For those who have been searching for a home for a bit, you might be noticing now that rates advertised have started to change in what is actually being advertised. For many years, it has been traditional to advertise interest rates that are without points or costs, no points. But I've already seen multiple advertisements for rates now with 1 point or 2 points. But for the general consumer, what is a point, and why would you even pay for one? For starters, a point is a phrase that alludes to paying 1% of your loan amount. So if you were borrowing $350,000 and you were paying 1 point, you'd be charged $3,500 at closing as a fee or a closing cost for receiving your mortgage. Points or discount points lower your interest rate in exchange for paying an upfront fee. The converse to this would be receiving a lender credit, where a lender lowers your closing costs in exchange for higher interest rates. And they don't move in exact increments of 1 or 2%, but rather they move based on the market. So getting a lower rate by 0.125%, which by the way is an eighth of a percent lower, could be 0.5%, and with additional market change could soon move to 3/4 and then up to a point. So it's liquid in how it moves. And the same goes for getting a credit. One interesting trend, though, that has emerged over the last quick change in interest rates is that it's made it tougher for a lender to cover closing costs without really cranking up the interest rate. Years ago, it was common that a lender could actually cover your closing costs for increasing the rate only by 0.25 or 0.375% in rate over that of the market. But in today's market environment, it's usually more like 0.5% or even 0.75% in interest rate to get your closing costs covered. Now, why would you want to pay a point? The two most common reasons are for qualification and because you would get a return on that investment quickly. So let's say, as an example, you were pre-approved for a home purchase at $350,000 at the rate of 4.375. You go under contract only to find out that the rate has moved up to 4.5% and you no longer qualify. Assuming you can afford to pay the discount point, whatever that might be, to qualify, you would be able to get the rate back down, which only leads to a lower monthly payment, and then you can qualify. For the second situation, where you might be receiving a return on buying down the rate, it's not about the necessity to simply buy down the rate or how long it would take to get back your investment. For this example, let's assume you can buy down your interest rate for 0.5% on a $300,000 loan. Basically, you'd be saving $22.52 per month for an upfront cost of $1,500. Now, if you take the $1,500 and divide it by the savings of $22.52, you find it takes 67 payments before you would have saved enough to offset what you paid up front. Whether or not this makes sense to do simply comes down to whether or not you'll be in that same home using the same financing for over 5.5 years. If the answer is yes, then you would save $22.52 each month after that break-even point. If the answer is no, then there is no reason to pay the discount point unless you are needing to lower the rate to qualify. The bottom line is that in a raising rate environment, we're going to see more and more options with paying discount points. In the end, you want to make sure you understand what it costs to get that rate and whether or not it's a good option for you and your personal finances. Now, if you found this helpful, be sure to tune in the coming weeks where I'm going to review the differences between a note rate and an APR rate. Until then, thanks for watching this episode of How Much Mortgage Can I Afford? And keep in mind, any of your needs you need for your own home financing, that is what we are here for, to help you navigate this world. Thanks for watching. We'll see you on another episode.